Good evening, everybody. Welcome to this week's Inner Circle session. I'm delighted to see you here. Thank you for joining me, and I hope your week has gone well so far. Yeah, thought we'd do something sort of strategy orientated today. I hope that's okay. We'll have a look at some charts along the way, of course. And good evening, Simon. I hope you're well. And you guys going fine, Keith, so far? Hi, Neil. Hi, Hugh. Hope you're all good. It's always appreciated when you guys can say hello. Whoops, got a little bit of an enthusiastic forward move there, but I'll just put this important message, just to remind you this is for educational purposes only. Please remember to do your own due diligence on anything you see here. Make sure you follow trading plans and make sure that you manage risk on every trading connection. Thank you, Sonia, for the heads up. And likewise, Wayne, good to see you both here. Right. Okay, so what we're going to do is we'll have a little whiz around the markets, just see where things are for right now, and then we'll have a look at some charts along the way as we're discussing what we're discussing. So I hope that sounds all right, but of course it's your session, so if at any time you've got questions you want to ask, then do so. Lance, welcome. And so as the title suggests, then we're looking at sort of four things that maybe are not part of your plan, and what I thought is I would present these and make a case for why it might be a good idea to consider them at least. Now, for discretionary traders, it's fairly self-explanatory. For hybrid traders, it's very relevant, and I know we've developed some tools around those for those of you who've been part of those programs. For EA traders, it sort of helps put strategy together in terms of maybe these are things you should be considering inserting into EA. So I think the relevance is really broad. I forgot to mention that for you guys on YouTube, thank you for popping in. If you're watching this as a recording, then of course, delighted to see you on that too. If you feel so moved, you can click a like and make comments and that sort of thing. It's always welcome. Hi, Roger. Right, okay, let's get into it. Let's just have a quick flick around markets to sort of kick things off. I think we might just check in on where everything is. It's obviously quite a busy all week for all sorts of reasons. But the major reason why today is has been a busy one is this core CPI number, which came in actually okay. So we were expecting a slight tick up, but we actually got better than expected on the core CPI, and as expected on the year-on-year. That's good. That was overnight in the US or this morning, very early hours of this morning on Australian time, so half midnight. In terms of today, we've got sort of trade balance numbers coming out of China, which were generally positive. That's good. So it's not been a bad day for data, really. If we look at what's coming up, then of course we've got the second round. We've got PPI, which in some ways is arguably as if not more important than CPI right now, because that is passed on to. Usually you see a sort of moving PPI often passed on to CPI. So all these numbers to be fairly low as well. We've got retail sales coming out of the US as well tonight. And on top of that, we've got some housing data. I've screwed everything up by putting this at your time, not mine. So it sort of put me out of kilter a little bit, but you can see there we've got Japanese PPI coming out in the morning. Probably the biggest number coming out tomorrow is the UK GDP, but we have also got employment claims coming out of the US. All of those are potentially important. Now, how have the markets responded to that? Well, we've been kissing record highs for most of the week, of course, and then we just got a sort of neutral day yesterday. What's the other factor in play is it's the start of US earnings season. Got merely big banks reporting this week. Most of the big tech start on around about the 28th, so around about a couple of weeks' time, we start to get the Teslas and Microsofts releasing data. So that'll all be very interesting in terms of how it plays out. So the rest of this week will be other banks. A couple of airlines thrown in as well. I think Delta reporting this week, maybe even tonight as well. Let me just check. It might have been last night, actually. Already done. Already done. So we've had earnings growth. Be interesting to see how not just Delta respond, but also the other airlines as well. We can check those out in a moment. Right. Okay. As for the futures, well, the futures are looking slightly lower than normal. We've got a fairly nice response. The world in Europe, but it's not for any records. Well, it is breaking record. Actually, we've got the FTSE up. We've got the CAC around up. We've got the DAX pretty neutral. Yeah. So geopolitics still very much in pipeline. Trump's just flooding the world with stuff at the minute. What that means is that a lot of the stuff is taken over. Here's his underling, Mr. Vance. So just watch for any headlines around that. The US is suggesting that Greenland is technically important for the region for national security. Those strategically important, not technically. The reality is, they've got lots of minerals that the US wouldn't mind putting around you. There is pushback already from Denmark, pushback from Greenland. So it'll be interesting to see how that plays out. But the latest narrative is that we'll have Greenland either the easy way or the hard way. Read into that whatever you will. Right, let's have a look at some charts, just get the overview of where things are. I'll show you some things along the way as well. That's what I wanted to find. So here's the US 500 today. You can see how choppy it's been over the last few days. But the reality is we're still pretty well near record highs. During the session last night, did we hit 7,000? Not quite. We're three points short of 7,000 on the futures contract. So still looking good. Earnings are going to dictate whether it stays here or not, of course. The Nasdaq has underperformed of late, primarily due to twitches about in the AI space. But we did test that sort of 25,900 level, which looks important. 26,100 is the closing high. Let's just look at some other things of interest. Gold just keeps on going again. We're going again on gold. Can you believe it? We saw a reaction when Trump was talking about hitting Iran. This is this candle. And now we just keep on moving up. 5,000 very much in the crosshairs. We're at 4,636. You don't have to say any more than its record highs. And if you look at silver, why isn't the silver chart showing? Let's put that on. There you go. So there's the silver futures there, obviously looking at record highs again. Nearly $100. That's incredible for silver. Very popular with investors, obviously. That gold is actually really quite expensive to get into right now. Lots of central bank action on going into gold. Interestingly, it's worthwhile keeping an eye on the USD. So if we look at the USD, It's the USD. Let's look at the USD and Euro USD. Sorry, the charts are a bit all over the place. For some reason, my MT5 accounts are looking a bit wobbly at the moment. But I managed to get one back up and running. I must have deleted something in error. So I need to reinstall all account numbers and passwords and things, which is a little bit of a nuisance, but it is what it is. But you can see there the Euro USD, the USD has been quite strong lately. We're now in a sort of range on the Euro USD. If we look at the US dollar index, you can see there we just seem to again hit a sort of pause point to what's been a fairly positive run up from the middle of December through to Jan. But gold's going up anyway as a potential hedge, I think, is what's going on there. Copper is retesting record highs. There's the record highs again. Standard behavior for copper. It's every time it gets to record high, it just seems to get obliterated for a day, and then off we go again. But yes, there's the record close at 606. I suggested, for those of you on the Monday session, I suggested maybe a 608, 610 was a good place to look at. It's testing that today. You can see there since the early Asian enthusiasm, we've given it all away. So interesting on copper for right now. Oil is having a bounce on the back of chit chat about Iran. Venezuela made very little difference. Very cool. Thank you very much. Look forward to having that look at that later. And if we look at Bitcoin, which also looks interesting, we do look as though we're potentially breaking out of a range here that we've been in for some time. But intraday, we tested this about 2 weeks ago. And it's pulled back again. But this looks slightly more convincing, although not as convincing as possibly it did earlier in the session. So again, we're towards the lows of the session, but look as though there's some short-term support in between around about 95,000, 95,750. I've had 1, 2, 3, 4 weeks tackle this level. So it's one worth watching. If we get a breach of this, we could see the sell-off just occurring over the next little while. I don't know what's going on with this. As for US yen, it's obviously an EA that's opened short, and it looks pretty good at this stage. It's heading towards that profit target. If we just put on, we'll check whether it's an EA or not. So there it is. It's a fake out. So essentially, we had a breach of a range, and it's faked out back into the range. And he's looking for the bottom of that range to be hit for a take profit. Should have trailed the stop in, but that's looking like a nice trade. But whichever way you slice it, the US yen is looking like this. So again, highs on the back of some strength, or rather weakness in the yen, which is weak against most things during the week. If we look at the Aussie yen again, you can sort of see this sort of pushing again back to test record highs. The Aussie is a bit weak today. There's the key level on the 4-hour chart at 106, 106.67. There's the range it's in at the moment. The breach of either of those could be interesting technically. 106.20 to the downside, 106.67 to the upside. And either way move, you've got those nice lines in the sand to create a fairly robust risk management on those. So that's all interesting. GB pound USD looks interesting on the 30-minute chart. You can see there we had a move up at the back end of the Asian session on the 30-minute chart. It's bounced around a little bit. Now we've got some buying coming in, but I'm not convinced of this due to all this price action over here. So let's not do that. So really, look, I think the US yen is really interesting in the short term. It goes against the long-term trend, so you're looking for a short-term kill. But if we do get a breach of 158.70, say, it could suggest the selling momentum continues, and a move down to 158.20 is not out of is a possibility. But we could, of course, get a bounce of 158.75. So this level here looks important for right now. I just put this trade before what happens next. So there you go. There it is. Is it going to go? So there we go. We've got that's my FX chart of the day. I like the look of gold or copper. Keep an eye on both of those for the broader commodities coming. You should be triggering now. A smidge of truth going. 158.75. Yeah. Okay. So it was 0.4 of a pip away from triggering. Right. Anyway, let's do some learning. So the session tonight, what we're sort of really going to cover is or what the motivation was, is that most plans define entries, not conditions. That could be the difference potentially between a trade that follows a plan and a good trade. Good setups fail when the context is wrong. That's the bottom line message from that. We're going to look at why that is. So it's about decision quality, not new indicators. You've got enough indicators to be going on with. And if you want it in simple terms, it's about why traders think they can do the right thing and still get inconsistent results. So by doing the right thing, you'll have heard me sort of profess this mantra from the rooftops, is doing the right thing is trading consistently according to plan. But maybe there's other things you need to include in your plan. Here's the message. So here's the pain point. Clear rules don't necessarily mean consistent outcomes, even if you follow them. Many setups look valid if you just look at the setup in isolation. So if we look at a potential setup here for a possible short trade, that we might say, well, look, this is good. But are we ignoring market context? Are we sort of saying, hey, look, maybe this is okay for a short-term kill? Maybe the chances of a continuation of this are limited by the fact that this, if you look at the longer time frames, is against the overall trend. Well, the 4 hours looking quite weak. It's still in an uptrend. It could be seen as just a retracement in around about 20% of the previous day's candle. So logically, that's market structure and market regime in play. So on the shorter time frames, yep, it looks great. On the longer time frames, it maybe doesn't look so sustainable. So individual trades may look valid in isolation, but it's interesting. If we don't have the right filters in place when we've got our entry criteria put together, then it might allow low quality, or as we call them, lower probability trades through that you take from anywhere, and that doesn't matter whether you're talking EA or discretionary. The bottom line is with any trading system is that selectivity matters more than frequency, usually. So we're going to look at some of these in a bit more detail, and to do that, or before I do that, I just wanted to clarify a couple of terms, which I know I've covered before in webinars, but I thought it might be useful just to review. And it is the concept of market structure and market regime. Because together, these are the context every setup operates within. So market structure describes what price is currently respecting. So again, one of my common mantras is previous price action breeds price action. suggesting that what happened before is a big part of trading decision making. So things like swing levels, key levels such as support and resistance, they're all visible within a chart, and often it exists within a regime. And I've just shown you an example there. We've got a short-term support and resistance in place. That support, if breached, in isolation on that time frame, looks valid. But it exists within a regime that says, well, actually, the longer time frame suggests that maybe it's not quite ready to enter a new regime on the longer time frames. With a 4 hourly, it certainly could be classed now as range bound rather than an uptrend. Market regime describes this broader environment that the trade is operating in, so trend, range, transition, expansion, contraction. Regime is inferred from behavior over time. Okay, so and of course, one of the simple ways of looking at this is higher lows, which you had until this point on the 1 hourly chart, and then we got a lower low. So there's our up to that point we had higher lows, and then this created a lower low. So that's suggesting that in the short term we could see this move into the downside. Must have been triggered because of that trade in there and that. Does that sort of make sense? So market structure is key levels, swing highs. Got a support here now, which is based on previous price action. We've got a potential next support level, which is again based on previous price action. So regime sets expectations for follow through, and the efficiency of the setup essentially is what it's about. That's what to be seen in the context of the overall market structure. So structure, if you like, tells you where the market is. I'm going to have lots of these Mikeisms. Structure tells you where the market is. Regime tells you what's likely to work. But if you've got confluence or consistency between market structure and market regime, it generally suggests that it's in a good place. Now, some of the other things that we're going to look at are based on that sort of concept, but I thought it was worth just reiterating those two key basic fundamentals of market. What you're looking at in a chart. You look at a chart. I did actually think it would be useful maybe to do a shorter session at one stage and just put up a chart. You guys suggest it, and I'll tell you exactly what I see, exactly what I'm looking at. What are the key things? What are things I'm ignoring? And circle them all. So show you this is a chart, and this is how I would look at it in terms of my decision making. If that would be useful, give me a yes, because I don't mind doing that if that's going to be a useful thing to see. Often a sort of demonstration of that ilk can give you far more information than me just wobbling on with lots of bullet points sometimes. So here are the 4 elements and the decision questions they answer. So each of these 4 elements answers a different decision question, essentially was my thinking behind putting this together. So when we look at higher time frame confluence, you're trying to answer the decision question, is this idea aligned with broader market context? So if we're looking at that US yen, it would be a yes, but maybe even a no, but. Second thing we look at is space to the next level. Sometimes let me term it proximity. And really this is answering the question, is there enough room for the trade to work as you expect it to do so? So, and of course that goes back to what you're setting expectations on. So if your expectation is I'll take trades if they give me more than 1.5 to 1 risk reward, then that's something you check. You can't talk about this in a bit more detail later, but you can't subsequently say, right, I'm going to just enter this trade now because it looks like an entry, and ignore the fact that perhaps the next key level of interest is less than 1.5 risk away. Yeah, got lots of yeses. I'll do that for a future session. And remember, it's just my opinion in terms of how I would look at things. It doesn't necessarily, but if you can sort of say, right, okay, and get the process, what does that mean to me in terms of how I apply? The third element is market participation and efficiency. And this is to do with the effort, or i.e. the amount of trading going on. Is that moving price sufficiently to suggest that there may be some continuation in that? Or we've got lots of volume, which is essentially repositioning, etc., suggesting, well, look, we're not convinced, because you could see if we're convinced because price is moving too. Come back to that one. And then the fourth one, which a lot of traders miss, and is probably worth investing a little more thinking on from my point of view as well, is that invariably if you look at a trading plan, it's if this are all the case, then I'll get in. Or if this is the case and this one isn't, then I'll maybe do it in a smaller position size. So I thought I'd just invest a few minutes talking about setup invalidation, because it's something that's rarely covered, because it's not very sexy. Like here's your new indicator. So those are the four things. We'll look at each of these in a bit more detail. So the longer time frame confluence, and my guess is that most of you have looked at this in some way, shape, or form, because what you're doing is reducing the counter trend low probability trades, which that US yen might be. We might see, at least for the in the right now, we may have to see consolidate around that level that it's just tested and triggered that take profit on that short trade. You may have to bounce around, suggest it's no longer, or confirm it's no longer an uptrend on the higher time frames, and so hence we may delay or sanction an entry. The part of the problem is when people articulate this, they don't often suggest which time frame they're using and what must align. Is it okay if a longer time frame, for example, let's say you're going long, is it okay if the longer time frame is currently in a short-term range? Or does that preclude you from trading as you would? So it's not which time frames you're going to use for your higher time frames. So there's a school of thought 124 isn't a bad way of going. So if you're trading the 15-minute, 2 times that is a 30, 4 times that is the hour. Doesn't quite work out, but on MT5 you've got a little more flexibility in terms of the time frames you use. So you could do 1 hourly, 2 hourly, 4 hourly. You could do 5 minutes, 10 minutes. I'm sure you can do 20 minutes as well. Yes, you can. So that 1-to-4 is a ratio that many traders seem to like, based on GAN, I think. But don't quote me on that. Now, just to reinforce that an absence of full confluence doesn't necessarily mean no trade, but what it does is it changes your expectations. So it could be that says, right, I'll still take this trade, but I'll take less of a trade. Or it could be, okay, that's a barrier on that particular trade or potential concern with that trade. Let's just see if there's anything else that might be better first. That's where something like a scanner comes in really well, because you can compare 3 or 4 really, really quickly. Now, it's worthwhile just sort of saying this, is that higher time frame is checked after a setup appears and used vaguely as confirmation so the trend is up, or ignored, and let's be honest, I guess is that some of you do, I have in the past, when it conflicts with your trade idea, because you like your trade idea. You now own your trade idea. It becomes your baby. You want to nurture as a trade idea. So maybe it doesn't matter so much. It's okay. It's potentially only a short-term trade. So, but that sort of philosophy is not the right way to go. Intentional use is a high time frame is checked in and is defined in advance to set context and expectations. With and by that meets the gap what I was talking about before in terms of being able to know which time frame to have a look at. What are the clear rules for alignment? What are the clear rules for conflict? How setups are treated in each case. So it may be that you scale the amount you go in based on that, but that's predefined, it's predetermined, it's pre-planned, it's in your plan already in terms of how you're going to operate, because as soon as you articulate it in those terms, all of a sudden you're able to test it. So make your longer time frame check meaningful and consistent is the key message that I'm trying to get across here. Beware the vagueness of a trade is up. Okay. Element 2, as I've already referenced, is proximity to the next key level. I think it's so important. I'll see, this is what I'll see on many trading rooms type things. See, it's bouncing off that level. Interesting. So let's look at something else. Let's look at gold, maybe. Okay. Gold's not a good example because of the record highs. Let's look at copper. Okay. So let's say copper bounces and breaks this level at 606. Natural feeling would be, natural trader behavior would be, I've got a logical stop there. And as far as I can see, if it breaches that, then it's going all the way back up there. So, which is about 2.2 risk reward. Okay, so that's the way it would be looked at. However, if we look here, previous swing high is actually there at 610. Now that changes the dynamic a little bit, but because we chose to not scroll the chart back a little bit, and we're not seeing that, we would pick that up perhaps from a longer time frame. I mean, if we just look at the time frame, it's an uptrend. It's had a retracement, it's an uptrend. It's not a trend continuation yet. That's why we've got this sticky line here. We've got back to the hourly chart and move back over the blue line with the green line there. Now changes the whole dynamic, because what we're talking about now is risk reward that is almost one-to-one, just citing it. .53, 0.51, yeah, 0.2%. So essentially one-to-one risk reward. Now that's a completely different trade to the one that just looks in this area here. Now, one of the things you've got to consider if you're looking back is how far you look back. I mean, this is only 1, 2, 3, 4, 5 days, 5 trading days. So what was that? Last Tuesday, Monday, Friday, Thursday, Wednesday, Tuesday. So it's only yeah, it was the end of the last, because you can see all that price action there as well. So the last time was this, or a time when it was at this level and felt the breach was there, also here, also here. So there's all sorts of reasons for liking this, but beware in terms of what expectations you put in a trade based on proximity. That was a good example, actually. One pre-planned. So this all has to do with market structure. It's looking at previous swing highs, previous key levels. And market structure is all about how the price is located in the market structure as a whole. So this is about avoiding good entries with a bad location, if that sort of makes sense. And so there's two sorts of risk reward. There's mechanical risk reward, which we say what we're targeting on every trade is 1 to 2 or 1 to 3 or 1 to 1.5. Whereas we've got a structural risk reward, but the caveat to that is that it's got to be taken the full structure and not just the immediate structure. And that can define what reward is realistic before a trade is taken. Now, again, that doesn't necessarily preclude entry, but it alters the way you behave in terms of trade management once you're in. The reality is, the nearer the proximity level, the more necessity, perhaps, for more intense intra-trade management until you decide to close it at some point. Because it's got less wiggle room, there's less room to move and breathe. It almost at one-to-one, it either does or it doesn't. And it does or it doesn't fairly quickly. So again, you've got to see that as a limitation of a low proximity. And so in terms of planning, in terms of that concept of being more picky with the trades that you take, then it's only right to subsequently define your minimum acceptable proximity. Now, of course, the tricky thing is we can do that, but there's often going to be a niggle at the back of your mind, or one of those little devils sitting on the shoulder saying, well, what if you're taking it? And of course, once you see that a couple of times, you're going to take it anyway, aren't you? So what you need to do right from the get-go when you do that is, and again, this goes against what most traders do, is you start to record the trade you don't take. It doesn't have to be for long, but let's say you set your let's say your minimal acceptable proximity is 1.5. Your risk, or 1.5 times your risk. So if your risk is 10 pips, you're wanting a return of 15 pips. You could do it on ATR multiples if you wanted. That would take into account local or immediate volatility. So that would be another challenge in terms of which measure do you use. But as many people put their stop based on an ATR multiple 1.5, again, not being common, either from signal or entry point, then invariably a 1-to-1 might be 1.5 ATR to the downside and 1.5 ATR to the upside. So those are the two decisions. What's the minimal acceptable proximity, and what measurement are you going to use to determine that? I wouldn't use. The problem with using points or pips is that doesn't translate to other timeframes, other instruments, different volatility. So you're far better using either whatever you use to determine your risk level, you use that as a multiple, or you use something that alters, such as an ATR specifically. And so what we're trying to look at, really, if you want another mic quote, is that the trade isn't badly managed per se. It was just structurally unrealistic from the start. It didn't meet. If you're setting mechanical risk reward that's standard across everything you trade, then you're cutting yourself short, really, because you're putting yourself in a place where you're going to be entering trades where it was never going to make them without several tests, retests. Element 3 is market participation and efficiency. This has been the subject of a recent part of the hybrid course, bid trading course, made an indicator based on this, which I'm currently just refining the settings for, just to get something that looks realistic, and then we can test those, etc., etc. But the idea or the start point is that volume and price are the two leading indicators of market sentiment. Now, the easy way, and I don't want to play this down because it is important, the fact that if you have volume as part of your entry criteria, that's a good thing. It doesn't matter that it's tick volume, because that's a reflection of market participation anyway. So a standard might be that we'll have a breach over a key level, or a trend continuation, or whatever it may be, or a Bollinger bounce, trades outside and then inside, whatever it may be. And then subsequently we look at volume to determine whether it's a good one. Now there's a few ways you can do this. You can do average volume, but the problem with average volume is that obviously there are very different volume, very different levels of market participation throughout the day. So invariably, you're going to knock out the whole of the Asian session. And if something has a volume spike, you may get it good for three or four candles, but volume may still be high for several candles, but because it's below average, it's not traded. Now that's one way of doing it. So there's limitations with average volume. There's limitations. So what people tend to do is they tend to say, is it the highest? Is it higher than the previous? Or is it higher than the previous two, for example? And that's good. I don't want to deride those. If you've got those written in your plan, it's better that than nothing. But it doesn't tell the full story, because what we're wanting to look at is there's no distinction when we just do those of the two between activity and progress. And so therefore, all movement is assumed to be meaningful. When you look at the concept of efficiency, it's about, does the effort or the participation or the volume mean that there's a reasonable move in price or efficiency to respond to that effort? Does that sort of make sense? That you can have high volume and the price hasn't moved very much. That would suggest that maybe it's repositioning, maybe it's there's a lack of conviction. There's lots of people getting out as well as getting in, or partially closing, or baby stepping, accumulating in. So that's one end of the spectrum. One end of the spectrum is high volume, no movement, or very little movement. The other end of the spectrum is low volume, big movement. You might see this, or you might get a volume spike subsequent to, for one bar. And that, so you might get a price spike for one bar, but that is the wrong time of day. It's not based on anything substantial. Most importantly, you're not getting the volume to back up the degree to that move, which suggests that market participation, market belief in that move is limited. Healthy markets record effort with progress. So that's when this term of efficiency comes in. So if you take volume and you do a calculation versus price, it gives you an efficiency measure. And the bottom line is that poor efficiency signals at either side give a greater likelihood of idea failure. So on the side where there's too much volume, no price movement, it suggests that maybe you've got price exhaustion. In the incidents where you've got high price move but not very much volume supporting, it suggests that it could retrace in a very short time. So it's classic fake out behavior. I hope that makes sense. Let's see if we can just find an example of this. Okay, actually, let's just look at this. Double top on the Aussie yen, interestingly enough. So what I might do is the thing that measures efficiency on this. So this indicator was developed as part of hybrid, which, as I said, needs testing. What we'll do is put volume on anyway. Okay, so let's take volume. But what we'll do is also put on this. If I can find it. What did I call it? Efficiency, probably. Let me just have a look. Efficiency later. Right. So there it is. Right, okay, so if we put this in here, there we go. Let's just do, I need to alter these variables a little bit. Perfect. I'm going to bring. I'm going to change the. So I've been playing with this to try and find the right settings that would. So let's say that's 0.35. And this is 0.65. So we split it into thirds essentially. Okay, so if it's in this zone, it means that there's volume, but there's no significant price movement. You can see here, that's what we've got. So you can see the high volume here, very little significant price movement. Whereas if we look here, what we've moved into now is a situation where, though we've got lower volume based on this price move here. So we're now out of the healthy place, which is this midpoint here. So if you'd taken this trade here on the back of this bounce, so this 3-bar reversal here, perhaps on that candle there, or it's a fractal reversal, or it's a pin bar, whatever you want to call it, you could have taken a trade there. In terms of volume, it is still okay. It is in the healthy zone, so that would be a tick. I hope that makes sense. And it doesn't take long because because volume is a leading indicator and moves with price. It doesn't take long for this to change. So you can see here, this is the candle of interest in terms of trading that bounce. And you can see there, it's really quickly actually moved into an unhealthy zone. Took a little bit of a pullback. And then was okay. So this was a candle it was okay on, and then we could have traded that up to that point there. If you wanted to buy about 25 pips. So that sort of makes sense. So these would be the places you wouldn't be interested in taking a trade, and these places where you would be cautious. Now, as I said, you can set your own settings. I've just done that just so you can see nicely the bands. The general suggestion is it should be about 0.3 and about 0.7 would be a reasonable place to have these. So again, the little sort of quote with the takeaway, you write it down if you want, is efficiency will tell you whether the activity is actually achieving something or not. So has price progressed according to the volume that's been traded? Because we know that that's good evidence for a confirmed price move. So have a look at some of the trades you've taken, particularly things like breakouts. Are they really associated with a move which is high volume, or is the volume just looking a little shy, or even the candle looking a little shy, which is more commonly in a fake out. The candle looks a bit shy, volume might still be okay, but there's like, if you know an overplay of volume for the fact that price isn't moving very little, is a pretty strong signal that something may be about to fake out. Element 4, setup invalidation. Now, as I said, this is a hard one to come with some clear examples. I really like the concept, and then I thought, what examples can I give that are not bizarre or just a repetition of what we've covered already? So these are the ones I come up with. So I've got 5 examples. So what this is about is technically there's nothing necessarily wrong. It maybe mean that you could abandon your trade idea and look elsewhere. Number 1 is opportunity cost invalidation. So it's not doing, you're waiting for this potential setup to turn into an actual trade, and you waited so long. So it might be that you say, well, look, I'm looking for a great example would be I'm looking for a breach of a previous swing high. Okay, that's my signal. So you've got your swing high, your previous swing high that's been identified. and it gets nearly there, but then it stays there. It thinks about it. It's a little bit above, ups a little bit below, but not enough to give you that space you need to enter the trade. And meanwhile, if we're looking rather than looking at the Aussie yen, if we look at the euro yen, well, that's flying. So what we need to do is we need to be able to pivot. And again, that's one of the useful things with scanners, is to say that, hey, look, I've got this set up. Aussie yen is there, euro yen is going well now. So you want to be in the highest probability trade without overexposing yourself to absolutely every trade that sets up. And watch for overlap in validation. Again, this is a difficult one to try and define. This is really good. This has been a really good exercise for me because it forces me to try and put definitions about things that would concern me. So usually setup requires a clean movement, and initial setup through to an actual tick, tick, tick. The cleaner it is, the more likely it is to sort of be robust in terms of doing what you think it would do. If price action becomes overlapping, let's find an example. Okay, so here's an example. So here's our previous swing high. Now you could argue we should take into account that one as well, from a proximity point of view. But there is still probably enough between this and this to consider a trade. Okay. So there's our previous swing high. So arguably, this candle here looks as though it's interesting. But you can see here we've got lots of overlapping candles in a fairly short space of time. We've got decreasing volume here. That would actually be not a bad trade, but you can see how much these candles are overlapping. There's no clear break. The clearest break is possibly the one that happened when it breached this. You can see this one here is a relatively clear break, even though there was a next candle that was red, but it was still closing near the top of the candle. And then, of course, if you go in on that candle, clear break, nice healthy zone. We've essentially got this candle is higher than that one, this candle is higher than that one. And so we're potentially ready to go. That's definitely an uptrend of the last 1, 2, 3, 4, 5 candles. We've had 5 bullish, 1 bearish. So everything there points to a sort of strengthened move, not much overlap. A nice clean move into trade setup that fits with overall market structure as well. So that to me is a strong move, and of course it had a strong initial move. Now whether we would have been sharp enough to take that off or not at that stage, rather than see it go all the way down there, is based on our exit margin, of course. But I hope that sort of clarified what I mean by that overlap in validation. Event or condition-based validation. So obviously this is all to do with economic data. And think about, well, what's my standard length that I would like to be in a trade for? And then you've got to subtract that in terms of the time frame you're trading from the data point. So it's no good just saying, oh, I'm going to stop entering trades an hour before the PPI data tonight. Because by then, if you landed something an hour and a half before or 2 hours before, it's going to make really difference. If there's a big market movement with that PPI, the likelihood is you're still going to be in the trade. So what you need to think about in terms of articulating it in your plan is if you are going to enter, you need to do something. Prior to that, you need to have something in place that manages that situation. Or you have a set rule that says, no, frequency isn't what it's about. It's about quality of trade I'm going to take. So that's the third sort of validation. You might have been waiting all day for it to breach and decides not to breach until now, which is what's that, 2.5? Actually, not a bit more than that. Still okay. Probably about 4.5 hours till the PPI data. Might be enough. Execution quality degradation. So there are times in the day when spreads aren't at the best, when volatility is a little wobbly. You want some increase in volatility, because increased volatility generally is a sign that it's a tick. You want, if you have volume increase in volatility increase and velocity increase, and it's generally a good sign that this trade is possibly robust from a probability point of view. So if you have no volatility but wide spreads or potential or actual big slippage, you've moved into a stage in the market day where that is the case, then perhaps that's enough to sort of say no. Or if you, again, to use your forward-looking sort of your forward-looking lens, if you're going to be moving into a time where that is the case, then is it going to have had enough time to grow, to evolve into the trade you thought it might be before it hits periods of low volatility, wider spreads, potential slippage? So even though at that stage you're not defining an exit strategy, you're defining the length of time you need before it might move into a time situation, either from an event or generally an ordinary market time. That might be a barrier to entry. That might be worth something exploring. We are actually exploring that. Wayne, as many of you know, doing some great work on. We're developing a spread map to see if we can sort of identify times where that might be the case. Although that's got an automated trading or EA bias, the principles, particularly on exit, are really very important for any sort of trader. And then there's time invalidation. This is one I've balanced a little bit. But I sort of thought I might include it because invariably we've put it in a couple of EAs, and it's something that I've used, is that if you've got a signal followed by, so the signal happens first, and then you've got some qualifying criteria. So I gave the example before of a Bollinger bounce or a breakout, a fractal breakout. Then maybe it's a good idea that if you have got, if a signal is created, I've got 3 bars or 5 bars before it's got to finish doing its action. Does that make sense? With a previous swing high, it'll be different, maybe 30 bars or 50 bars. But certainly with a Bollinger bounce where it goes outside the band and then back in, is that, or a pin bar reversal, for example, it could do a pin bar. All right. See, this is good. This is really good. Perfect. But if we look here, there theoretically is a pin bar. And then it bimbles along forever. And so something else comes along that invalidates the original trading idea. It doesn't mean you don't trade it, just means you have a different idea, because what you've got now is a range. So what you work now on is a range that involves a breach of that. It's interesting. Does that make sense? So I wasn't sure about that, but I figured it was a good ad that maybe you should sort of say, if it's a signal orientated move, then it should begin to start to do its thing. So I'm looking for a signal, and then I'm looking for my other ticks. If it doesn't happen right now, how many times, or how many bars am I gonna sort of look at before I say, nah, it's not happening. So that's number 4. So invalidation, what invalidation is all about is stepping aside when the idea no longer makes sense. So it's not that it's technically wrong, it's just there's things which weren't part of your original idea, and if you articulate them specifically and unambiguously in your plan, then you can test them. So what it means is that you're not waiting to be proven wrong. You're actually you're the one that's in control of determining the parameters. So bringing it all together, really, So if these are four key considerations, so context defines what types of ideas are reasonable, space defines potential, participation defines the quality of the move, or rather efficiency, and the validation protects logic. Those four are true, should they not be part of your plan. I hope I've explained them sufficiently well to allow you to go away and look at them in a little more detail. But as you do that, consider this. I mean, look at some of the entries you've taken and say, well, can't put a tick behind these. This trade, and this trade I couldn't. What was the cost of ignoring these as a concept? So in terms of an ABC, if you like this as an idea, then review one setup you trade regularly, probably the most regular. Consider the four elements before entry and improve your selectivity, not complexity. Okay. So what you would do is you would do the what if scenario. So you would trade what you do already, but now you're doing this and you'd record the trades that you don't take because of these four issues. Ideally, what you would do if you keep a substantive journal, which actually gives you some good information to go back and have a look, that includes the one setup that you trade regularly, you could possibly identify those and do that what if scenario. Go back to the chart and say, well, was it operating in a context which is good from a market structure and a market regime point of view? Was there ample proximity to the next key level? Was there significant volume that was related to efficiency and price movement? And was there any of those invalidations in place? And then, of course, you can start to ask, what tools can I access to make this quicker and easier? Those of you working with me elsewhere on the hybrid trading stuff, this is exactly what it's about. And you know that we've already sort of started to develop ideas around this, and actually our context guardrail is based on this concept. But the reality is, it's up to you. I've sort of shared some stuff, shared my thinking, and asked myself some questions. Well, what do I need to do for me in this area? Because this is something that's sort of evolved a little bit more with a lot of the EAs that we develop based on price action. It's had to evolve a little bit more. What if an EA isn't working as well as it potentially could do? Are you missing a filter? What could those filters be? Let's go back to a chart and see what the discretionary picture might say. But the reality is that you have control of your trading future. You have a chance to create that. And so with everything that you hear, not just from me, but from anybody, the rules of the game are the same. You've got a choice to do or not do. It's really that simple. That sounds a bit Yoda-ish for those of you who are Star Wars. You can try or not try, obviously. But the principle is a good one. So I hope that's been interesting, challenging, giving you some things to think about. I think I've answered most of the questions along the way and the comments along the way. Big volume, no price move mean accumulation? Not necessarily, Sam. It's a great question though. It's interesting. If you got access to, if you trade shares and you've got something, it used to be, I've looked at it for years now, but there used to be a system called Iris that Corey used to use, which is who I trade options with. That was great because you could see the trades coming in. And so you could see trades at 43 and 43 and 43 and 43 and 43 periodic intervals. So that's how institutions tend to accumulate. They don't want to move price. They want to keep it where it is. If they have a belief that it's going to do better than it is now, they'll accumulate small and frequently so that they don't give the impression that there's lots of market participation. They want to stay in a range so it doesn't go out of that range, not excite other people for as long as it's possible, accumulate as much as they can in a way that keeps that price there. So probably probably a better sign is, I think you're in the right ballpark there, and it's good thinking. But probably the better way of sort of looking at it is that context of price isn't going down, but volume is still okay. So that multi-wick reversal. So I hope that sort of answers your question. That's probably how I would look at it anyway. Right. So there you go. To do or not to do? That's the question. So consider the 4 elements of today. Ask yourself the question logically: should I? If you think you should, you need to review the trading plan to incorporate the elements of choice and evaluate, of course, and then seek out those things, much of which are tools that help you make decisions quicker, easier, and smarter. Be able to see things that are otherwise you'd have to do quite a lot of work to see. That's the target. That's what you should do. And I hope that's contributed in some way, shape, or form to enable you to review what you're doing right now and perhaps take you to the next level. So there you go. That's the session for tonight. We've done our hour plus some, so thank you very much for being here and staying here. It's always appreciated. You guys take care of yourself. Enjoy the rest of your Wednesday. I will talk to some of you very soon. And enjoy the rest of your evening. Thank you very much, guys. See you soon. Bye.